Good afternoon, everybody, and thank you for joining the session. A couple of bits of housekeeping. I'm going to jump right into David's presentation. First and foremost, we want to thank everybody who joins us on these virtual sessions, as well as the face-to-face events. We appreciate all your feedback, so keep that coming to us so we can get better and better. Secondly, during David's presentation, if this is the first time you're watching a video with us, or I should say a virtual show with us, there is a live chat box to the right of the player. I will be looking for questions, so send over questions during David's presentation, and time permitting, we'll go until 3:15 Eastern. We will answer a couple live for you, okay? With that said, it's my great pleasure to introduce to everybody David Morgan, who is a widely recognized analyst in the precious metals industry and consults for hedge funds, high net worth investors, mining companies, depositories, and bullion dealers. He is the publisher of the Morgan Report, a world-class publication designed to build and secure wealth. In addition, David is the author of the Silver Manifesto and a featured speaker at investment conferences worldwide, including Money Show, of course. David, it's a perfect time to have you on the platform. We look forward to having you back, sir. The floor is now yours.
All right. Thank you, Joe. All right. Again, shout out to the Money Show. Thank you for all the invitations, both live and virtual. And this is for AI. So don't let me forget, I do have a copper opportunity for accredited investors in Montana. I am invested myself, so I am somewhat biased. And I have physically gone through the entire property with the lead investor and the geologist. So if you're interested, you can get a hold of me through our main email, which is support@themorganreport.com. That's support@themorganreport.com. So enough on that. Thank you, Money Show, again for all the invitations and allowing me to present both live and virtual. Disclaimer, so don't believe anything I say, even though I'm a straight shooter and honest as they come. Use your investment advisor. I'm not a registered advisor. Okay, so asset-backed reality. Welcome. We're going to explore why the world is quietly shifting from the system that we're currently in into perhaps this is to be determined an asset-backed reality. So, of course, as I've said hundreds of times, there's three words that sums up the entire global monetary system. It is every fiat fails. Three words. There's never been a fiat money system that hasn't failed in all of recorded history, and we could fail. The idea that I have, and I think most of us agree, that the US dollar, the reserve currency of the world, is not going to fail in the way that the Weimar Republic Rene mark failed, or the Zimbabwe dollar failed, or the Argentine peso. It's not going to absolute zero. It's not going to be the Venezuelan bolivar going to zero, where it's in the street and people don't pick it up. It's so worthless. That will not happen. What will happen, in my studied view, is we will have a new system. And the new system may still use the dollar or digital dollar. It could be a cashless society. But again, the dollar going to zero, I just don't see that. But we are near the end of the great inflation. Nixon closed the gold window in 1971, and we're well past the 50-year experiment. And the thing that keeps the credit system going on good faith is collateral. So if you're going to borrow US dollars or euros or yen basis gold, and you put gold up as collateral, then the bank that's loaning you the yen isn't going to have any problem whatsoever. I mean, that is solid. It's money, real money for substitute money, you might say. But we're out of collateral. I mean, basically now the full faith and credit of the United States sounds great in a speech, but what it really means is the ability to pay the interest on the debt, on the bonds that foreign governments and private individuals buy T-bills and T-bonds. And so basically the full faith and credit means the ability of the nation state to tax the citizens and the courts, their tax base, is enough to pay the interest on the debt. But it isn't. We have to borrow the difference. And it's not just the interest payments, which are exceeding the military budget and Social Security. So we cannot tax 100%. And even if we did, it wouldn't cover it. So what do? You re-collateralize, and that's what this is about. So what is re-collateralization? It's taking, as I just said, something that's backed by nothing with backing by something. So the global shift from financial claims to tangible value, trust through having real collateral. What we saw, of course, as I said, over the last several years has been uh, more and more debt expansion throughout all governments, all currencies, the entire system, and way too many derivatives. And the system's expanded beyond the ability to pay it back. It's a math problem. It's not a philosophical problem. So debt at one time can promote growth. I mean, if you borrow at 10% and you put up an apartment building and the rate of return is 15%, obviously you made a good investment. You borrow money at 10, can pay back at 15, you get a 5% spread, everyone's happy, and you put in that capital to productive use. Can you do that today? Of course you can. But on aggregate, on the average, on a GDP basis, is not being done. And the proof is that all the growth, I would say all, but most of the growth that's in the GDP figures of, oh, we got 3% growth in the United States. If you actually know how to analyze it, that growth comes from money printing. That growth, that 3%, 2.8% of it or thereabouts is based because you grew the money supply. Most people don't point that out, but unfortunately, that's the way it actually is. So, 700 trillion and all the derivatives, the confidence is waning. The US dollar, I think, is hitting a new low today. And that's the trend. And it's nothing to get really, really upset about, but this is why you attend conferences like this or presentations, because we may not have all the answers, but at least we're giving you the facts to think about. And then you can make your own determination based upon, let's say, hopefully worthwhile, worth your time evaluations and thought processes. So obviously there's cracks in confidence on a global basis. The gilt crisis not that long ago, a year and a half ago or so. The Treasury is fairly illiquid because a lot of the debt that's offered through the money center banks when they put up a bond auction are not being bought by foreign governments to the level that they used to. And that means someone's got to be the buyer of last resort. And that, of course, is the Federal Reserve. And of course, when the Federal Reserve buys the debt, it's monetizing the debt. So they're turning a bond or bond certificate, if you want to think of it that way, into cash. So that adds to the ready money supply, your spendable cash. And that's, of course, highly inflationary. The more cash out there in the market, obviously, the higher, potentially, the higher the inflation rate. So every financial panic is really a collateral panic. This isn't backed by anything really, but I can buy something real with it. And everything that I'm buying that's real with it, such as groceries, seem to be going up in price every time I go to the doggone grocery store. So now what am I going to do? This is the general public. I mean, you might have the same thoughts. I mean, this is a fairly select group and people that are, serious investors and have a high net worth. But real is real for everybody. We all eat. We all go to the grocery store or maybe have someone do it for you. Regardless, this starts to seep into the consciousness of the average person and they start to understand something's wrong. Most people don't understand how inflation is really created because they believe the rhetoric from the powers that be that, it's the greedy corporations or the store owner on the corners getting greedy or whatever. And of course, it's the banks themselves, it's the system itself that creates an abundance of currency. Record gold buying from 2022 on, it continues to this day. Gold keeps making new highs. It's over 5,000. And of course, institutions will be coming in more and more as we went through 2025 to 2026. Everyone on this call is probably pretty sophisticated, so it's referred to in the vernacular as window dressing. So your hedge fund managers, your money managers, etc., pretty much have to look good when they report to the shareholders or the the constituents that they report to will have to say, look, we have gold on our balance sheet. We bought gold, or we bought gold stocks or whatever. So there's been some rush into the sector, and I believe that's going to continue. So what is the highest collateral? This is as honest as I can make it. Obviously, I'm biased, but from monetary history and actual facts. I mean, basically, you've got your precious metals Energy, critical minerals, that's got more weight than it had before because silver, platinum, and other minerals. Silver's just been added to the critical minerals list. The government, the US government, will be buying and storing, stockpiling some critical minerals, silver being one of them. And other nation states have also jumped on board the strategic or critical minerals asset base. So there, I would say, is an insatiable appetite for the quote unquote critical minerals. And that, of course, is all the REEs, rare earth elements. Land, of course, any productive asset, improved land, real estate, or farmland. And then lastly, paper and digital claims. And, some digital claims do have real asset backing, some do not. I'm speaking primarily about the ones that do. And paper, what I'm really referring to there would be like stocks in a real company that has a real, real production, like an automobile company or Exxon Mobil or one of those, type of situations. So that's real collateral. Gold has returned as a tier one asset under Basel III. Probably everyone knows that. Silver remains undervalued industrial monetary metal. Even $100 silver, it's still undervalued, although obviously it's caught up to gold as far as the gold silver ratio. You go back a little more than a year, it was 100 to 1. Now it's at 50 to 1. So it's outperformed gold on a 2 to 1 basis. And, I love to tell my gold bug friends that don't want silver or think much highly of silver. Well, if you really want a good gold position, buy nothing but silver right now. And then when the ratio gets down from 100 to 1 to 50 to 1, swap the silver for gold and double your gold position. So it costs you half as much. Anyway, I digress. So the CBDCs, the central bank digital currencies, are the control model. Whether or not that will take place remains to be determined. I believe it will, or something along those lines. We hear a lot about the stable coin, which is really a CBDC in disguise without necessarily government control. It's under quote unquote private hands. And I would say it's really quasi-private because what is a stable coin? Stable coin primarily is a debt instrument of the United States government. In other words, a T-bill, T-note, or T-bond. It's a treasury obligation from the United States government, primarily. They have some gold, they have some other assets, some mortgage securities, that type of thing, but primarily it's US debt, which makes me laugh because it's a non sequitur. I mean, when you say it's a stable coin and it's tied to one of the most unstable currencies that exists, except all the other currencies, you've got an unstable US dollar, and that's the basis of your stable coin. So you got to think these things through. The asset-backed digital settlement, of course, is still based on trust, and which system, how this unfolds, will define what we are doing in the financial world going forward. Energy and metals, that's the best place to be right now. Finance meets physics. Energy is the ultimate reserve asset, as I've said many times, that the world, money makes the world go round, really is a misnomer. Energy makes the world go round. Primarily, even today, that means oil for the most part. We can't print it, and we can't print lithium or silver or any of the hard assets. Signs of the transition, of course, is gold repatriation, which Germany did years ago, got most of the gold back. BRICS, of course, is using, and this is in question. I mean, the BRICS obviously have band together and they're trading each other's currencies every day. How much gold is actually within that system, and will there be a gold-backed currency within the BRICS? Hasn't happened yet, and I don't think it will happen. It could, but a lot of my contemporaries talk about it's already there and it's all done in gold. That is not correct. It's done currency to currency. So Brazilian reals are traded for yuan, for example. But it is something different than the existing system, and we do have to pay attention to it. So what does a reset look like? Currency devaluation, debt restructuring, and new collateral. What fails first? Well, as I said earlier, bonds, we're losing trust in the bond market, and it's not, Mr. David Morgan and the Morgan report. It's the other banks, it's the other nation states, it's investors, it's insurance companies, pension funds. Basically, our debt is being questioned, and it's not as readily bought as it was in the past. And there's a good reason for it. Mathematically, it cannot be paid back. So how is it paid back? Well, in all previous instances where there's been a failure of an unbacked currency, it's been by continuing to depreciate the currency, thus the debasement trade, which is putting up, the gold price higher and higher. And, I have to laugh in a way because I talked about currency debasement, probably the first lecture I ever gave when I founded the Morgan Report. And that was 25 years ago. But regardless, loss in trust, equities reprice, and derivatives implode. I mean, these are all shorthand versions, but I think as an engineer still, and I like to get right to the facts and, not do too much detail, because the further you go down the rabbit hole and explain it's going to happen like this on a Tuesday morning, and it's going to be at the Bank of Japan when the yen carry trade unfurrows further, blah, 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 blah. Those things will happen. Exactly how, no one really knows. So the big picture is losing trust, and that's primarily in the credit markets, which means the US dollar. Equities, meaning the entire stock markets, not just the Dow and the S&P 500, will reprice. And the derivatives that are leverage bets on top of leverage bets on top of leverage bets, betting primarily on interest rate shifts. Somebody wins and someone loses. And if the counterparty cannot pay, guess what? The person that made the loan loses as well. So if you make a loan to XYZ Corporation for a corporate bond and they go under, you might get whatever's left up if you're a bondholder, because that's how corporate bonds work. Most of you know that. But you might get back 30 cents on the dollar, by the time they sell the real estate and all the machinery and the desks and the computers. Since you're a bond owner, you will get real assets on a pro rata basis, how much you own of the company, but you're not going to get, full backing. And what did I just tell you? I told you the actual collateral that backed the corporate bond, which does exist, the building, the hardware, the computers, all of that gets divvied up, basically. So anyway, it is sort of a mess, but we've been here and done it before. Just haven't done it on a worldwide basis before. So in a crisis, liquidity, we go from derivatives to bullion. That's the extra pyramid. If you ever heard any of my lectures before, or you can look it up, David Morgan, extra pyramid, or just look up extra pyramid. It explains the liquidity pyramid. Is pretty easy to understand. And as we go from derivatives to gold and silver, those positioned early will really do well. And of course, I've been positioned in the metals in various forms for years, as you well know. Even though my average price might not be as low as you might think, it's certainly much lower than the $100 silver and $5,000 gold. Investors framework, physical metal first. That's what I consider insurance. Some people don't like the word, so don't use it. Royalty and streaming firms, this is for cash flow. Some people say, well, buy the metal. It's not worth buying the equities because the metal outperforms. On aggregate, it does. On the average, it does, but not in reality. In reality, if you bought my favorite silver streaming stock, it's up 30x. And silver is up 20x. $5 silver times 20 is 100. 30 times 5 is 150. So silver would have to be at 150 to equal the equity that's in my top tier. Big money in this company. Safe, blue chip. And you get dividends. And on top of that, the tax treatments differ for U.S. citizens. If you're in the equity side, you're taxed at a much lower rate than you are if you own physical gold or physical silver, which is taxed as a collectible, even though I don't think it should be. That is what the tax law says. Quality miners for growth, and strategic metals and energy. And I will be writing a lot more about energy in the February report, which will come out on Saturday. I am not doing the analysis. I did an energy letter a while back, and I just don't have the time or the energy to do it. So I've teamed up with somebody in Canada that's been in that sector as a specialist for probably as long as I've been doing the metals. And I'm just going to basically segue to him. And if you want really good energy picks with a similar philosophy of mine, big money and big companies, medium money and medium companies, if you want to bet, make small bets in the wildcat sector. So I really like the way he does it, and I'm going to recommend him in the February issue.
David, pardon me, but we have about 9, 10 minutes to go, just so you
Okay,
know.
thank you.
You're welcome.
So we're almost done with the slides anyway here. So from paper wealth to real wealth exists, and I say outside the system. I mean, real wealth does exist within the system too. I mean, a good corporate bond that's, not a zombie company really making earnings, paying their interest on the bond, and maybe it's selling very close to book value. I mean, that's real. That's within the system. And some companies are out there that are, real deals. The problem I have, generally speaking, is, the Mag 7 and the way that these stock indices are weighted. They're really not telling the total truth. And most cases, in almost all cases, we are overvalued relative to historic means. I mean, think about it. If you're going to buy somebody's business from them, 10x is probably the most you'd want to pay. You put up $1 million to buy their business, and over 10 years, you want to get, paid back your commitment, your $1 million, and have a cash flow that's worth it, maybe 100,000 net out of that business or whatever. So to sell at 30, 40, 50, or not even have a PE because they don't have any earnings, which is quite common today, especially in the tech sector. Not saying I'm against it. I mean, everybody can make up their own mind. I'm a free market thinker, but basically we buy a business because of earnings. You're buying a business because it's momentum, go ahead. But anyway, as this thing unravels more, all I'm saying is that you'll become back to more realistic, more conservative, more, let's say, common sense approaches to valuations. Freedom dies when money lies. That's a paper I wrote about 1.5 years ago. It's a dissertation on there is a direct correlation between honest money, honest people, and a high moral society. And when you have an immoral monetary structure that some people get to print it for free and loan it out at face value plus interest, which is really counterfeiting, that goes through the entire system and really has an effect on how people think and how they act. So it is an ethical situation, not just an economic situation. So that's the end. I'm going to take questions here in a minute. You can subscribe at that link, the mortgagereport.com join. If you join, you will get a 30-minute session with me for free. I'll go through the report. Front page is over on the left there. And I just go through the portfolio, basically. I answer any of your questions, but basically I go through the portfolio. Which of the top tiers I like? There's 6 in there, I think. And you don't need all 6. 3 is usually sufficient. And I show you which ones at this time. And then we talk about the mid tiers, the junior producers, and the speculations. But that's near money you want to, it's gambling money. I'll tell you which ones I like and why, but again, small bet. And also what we do if that bet starts to win. And that's one of the reasons you pay us. It's not just me. I have a whole team. I have 2 stock guys and, our webmaster / video and all that stuff. So anyway, that's it. If you just want to phone in, get that phone number, 480-325-0230. That is a direct line to the office. And then email is easy to support@themortgagereport.com. And you could probably, that QR code probably still works. I don't know for sure, but that's how to get a hold of us. And again, if you're interested in that copper project, which is for accredited investors only, it's not a hard sell. I will connect you with the CEO and you can set aside some time. I'll go over the whole project. It is in a good jurisdiction. As I said, I've been there. There is water and power right there. Roads are right in there. but it's big. It's big. It's not something that we, the investors, would be able to take from finding the asset to full production very easily. But we already know that ahead of time. And that's once we get enough material to make it economically feasible, that's when you do a JV, a junior venture, joint venture, or be bought out or whatever. So there is that. I think that's everything. Um, and again, in every reset, the wealth doesn't disappear. So really, it's not. You don't need much fear. I mean, if you're debt free, have good assets, when things reprice and you have the ability to purchase when other people are desperate to sell because they must, you will see the wealth change hands. And that happens in all the great resets. So obviously not the end of the world. So Joe, I'll give it back to you, see if you have any questions. And if
Thanks,
not,
David.
I can move on.
No, no, it's great. We have a couple of minutes left. There are a bunch of questions that have come through, but I'm going to try to get to just a couple with you quickly before we tie it up for the day, for you anyway. How sustainable do you think current price levels, we're referring to gold and silver, are currently, and under what conditions would you expect a major correction versus a continued bull market?
Yeah, real tough. So let me give you as many facts as I can. Right now, the silver market is going no bid. No bid from the wholesalers. So the wholesalers are saying, David Morgan calls up, and I call my primary dealer and I say, hey, Bob, I want to sell 4 contracts worth of silver bars that I own outright. Bob says, I can't sell them for you. I said, why not? Because there's no wholesalers that are buying them right now. Why not? And here's the part that most people don't understand. The whole system runs on credit, as Bill Holter says. So if I'm XYZ wholesaler and I've got a credit line of $20 million, when someone comes to me and says, I want to sell my silver or gold back to XYZ wholesaler, I say, fine. And they buy it. And they buy it and they buy it and they buy it because they're a market maker and they're pretty much required to buy it until they run out of credit. So now if my credit limit is at 20 million and someone else says, hey, I want to sell my silver, the wholesaler says, I can't. I don't have any more credit. I have pegged it out. Now think about it from the wholesaler aspect. They're buying silver at a very high price to make the market, and they're borrowing money at today's rate, which is what, the 10 years around 4-something%. So even with a really strong relationship with their bankers, probably 5% anyway. So they're buying silver at their offer. You're accepting their offer. And so it might be $5 under spot. They pay you that. And now they're locked in because there aren't any buyers on the retail side. It's all basically it's all coming out of China. So now they got to hold that inventory that costs them 5%, not on an annual basis, but it adds up. And they got to store it. And they can't buy anymore because they're out of credit. So they're in a bind. And the worst part of it is, with this on again, off again backwardation, you can't hedge. Now you're really in problems because you borrowed money to buy it. That's costing you. And you can't hedge because the front month is more costly than the back months. So you're buying it. Now with the delta, that $5 under spot, I could be fudging a little bit that they can hedge. So maybe they can based on the discount that you've accepted to sell it outright. But that's the state of affairs, especially on the silver side. So earlier, the refiners were not taking anything that wasn't 999 fine. And now they're not taking anything. And I say they, it is not across the board. It is not in all instances. I won't name names, but 2 of them are the largest European wholesalers, well-known names, and they have stopped taking in new inventory. So it's a very, very interesting. Most retail dealers are really bidding back strong. Like I think Money Metals is giving you $13 on their spot. Others are in the 10, 9, 10 range. But my thoughts are that I'm concerned. When the market's really locked up like this on being able to sell, especially think about the dollar going down further, which I think it's making a new low today, as I said earlier, if it continues down, there'll be more people wanting to, probably be more people want to buy silver, but at over 100, there aren't many. And maybe more that really want to sell because the quote unquote price could go up basis what the Shanghai Metals Exchange and the Shanghai Futures Exchange is bidding. But if you sold there, oh, I'm going to put my, $100 million worth of silver on a boat and ship it to Shanghai and sell it to them. Okay, fine. But you're not going to get US dollars. You're going to get renminbi. And so you're going to have to convert it. So it's a bit of a mess. It does have me concerned. If you could find someone to sell it to and lighten up, it might not be a bad idea. Do I think we're going above 100? We're already above 100. Do I think we're going to 200? I think we could, but I don't want to get everyone overexcited. I've already told all our premium members to go ahead and start selling out in tranches once we get above 100. So 100, 120, 140, 160, 180. Keep maybe 20% for long term to pass on to your heirs. That's my basic idea. Probably ran out of time, Joe. Are we done?
Yeah, good advice, though. Really good presentation today, Dave. We got a great crowd in the room. Folks, I'm sorry we couldn't get to all your questions, but I would get with David directly. Obviously, follow the Morgan Report, et cetera, because David does a lot of good work for us and for a lot of his, obviously, his subscribers. So with that said, David, it's really good to have you back. Really great we're excited that you were able to do it for us today. And we want to thank everybody for joining the session. If you're in Las Vegas next month, February 23rd to the 25th, come see us at the Paris Resort. It's our first live event of the year. We've got 7 live events throughout the U.S. this year, but definitely come back and see us. David, thank you again. I'll tell Debbie you said hi, and hopefully
Okay.
we'll get to see you again soon, sir.
Great. Thanks so much,
Thank
Joe.
you. Have a great week, everybody. Enjoy the rest of the sessions and a great week to everybody. Thank you again. Bye now.